Can President Trump take over the Fed and lower rates? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to a weekly update. So this past Wednesday, the Fed kept interest rates unchanged at between 4.25% and 4.5%, and reminded everyone that it was in no rush to cut. This was as industry observers had expected, so markets stayed more or less calm immediately afterwards. Well, it didn't stay that calm for long, as is almost to be expected in our current, often turbulent market environment. This seemingly unsurprising rate decision quickly escalated into a bit of tit for tat between the chairman of the Fed and our president. It seems that Fed Governor Powell put at least a bit of the blame for higher prices on President Trump's tariffs. When asked by a Reuters reporter at the FOMC meeting how much of the higher inflation forecast for this year is due to tariffs, Powell's answer was that while it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs, the answer is clearly some of it. A good part of it is coming from tariffs. And I think that ABC summarized the president's response to this quite well. Trump criticizes Federal Reserve, calls for lower interest rates. Given that Powell and Trump have had some contentious moments before, it's no wonder then that the questions and emails started coming in from our community about who might have the upper hand if the Federal Reserve and the Trump administration were to go head to head, and how this might move interest rates. With that in mind, here are the 5 questions that we'll be covering in today's video. 1. Can the president overrule the Fed to lower interest rates? 2. Can the president replace Governor Powell or other members of the board? 3. How else could the president try to influence the decisions of the Fed? 4. Which treasuries rose the most and which ones fell this past week? And 5. What are the yield expectations for the upcoming week's 2, 5, and 7-year treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? And for our Diamond Nest Egg regulars, 5 questions per video is not the new norm. This is just another one of those meaty topics that need a more detailed explanation. As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Can the president overrule the Fed to lower interest rates? The short answer is no. The president cannot overrule the Fed or force them to lower interest rates. Interest rates for our country are set by the Federal Open Market Committee, or FOMC, which is independent in its decision. This independence of the Fed is enshrined in the Federal Reserve Act, which means the president cannot override it unilaterally or on his own volition, but would need to go through Congress to change the law. Now, it wasn't always like that, and for the first few decades of its existence, the president and Congress intervened quite directly in monetary policy, such as when President Franklin Roosevelt, during the Great Depression, assumed emergency powers that explicitly took the United States off the gold standard, which in today's terms essentially means he opted for looser monetary policy, lower interest rates, and a devaluation of the dollar all in one go. Basically, decisions that would be the Fed's to take in today's world. The reason why the Fed, like nearly all other central banks in major capitalist democracies, was later given this independence is that rate decisions will often involve trade-offs. An effective fight against inflation may, from time to time, require higher rates now that may slow down the economy temporarily, but maintain price stability in the long run. And this need to do unpopular things from time to time to keep inflation down is what has so far convinced Congress not to change the Federal Reserve Act that gives the Fed its independence. As Brookings phrases it, Congress could, of course, change the law, but no bill to alter the Fed's mandate or governance has gone very far. That's because members of Congress generally recognize that if they or the president were able to directly influence the setting of interest rates, higher inflation would be the likely outcome. And it's not that other presidents haven't been tempted before, but the chances of Congress changing the law to allow the president to set interest rates seems remote at this point, at least in my opinion. So which side are you on? Do you think that interest rates should be lower like President Trump does? Or do you think that Fed Governor Powell made the right call by keeping interest rates unchanged? Or are you in the camp that thinks rates should go even higher? Drop a comment below and let me and the community know. And let's move on now to the next section of today's video. Can the president replace Governor Powell or other members of the board? Again, the short answer is no. While the president appoints the members of the Federal Reserve Board, subject to the confirmation by the Senate, the president cannot remove them. And for those of you who may not know this, it was actually Trump who nominated Powell to be the chairman of the Board of Governors of the Federal Reserve in 2017 during his first presidential term. So, as I was saying, the president cannot replace Powell or other members of the board before their term ends. The only exception would be a removal for cause, but that would need some serious misgivings above and beyond just a disagreement on the interest rate policy. So once a member of the board of the Federal Reserve has been appointed to their 14-year term, the president cannot force their removal. Now, there is a bit of chatter in the market about whether the Trump administration might try to test the limits of its power, as they have done in other cases with independent government agencies. And as this headline from Bloomberg suggests, Jerome Powell says Trump can't fire him. That might change. Without diving into the weeds, the background to this headline is that Trump recently fired both Democratic commissioners at the Independent Federal Trade Commission, or FTC. This FTC case is expected to make its way to the Supreme Court, which may potentially side with the administration and allow the president more control over independent agencies. The reasoning for such a decision would probably be along the lines that even independent agencies are ultimately part of the executive branch of the government and should not be allowed to lead their completely independent lives, so to speak, but be ultimately aligned with the president and his agenda as the constitutional head of the executive branch. That said, even if the Supreme Court were to let Trump fire the FTC commissioners, the Federal Reserve might still be protected. As this other paragraph from Bloomberg points out, the Supreme Court last year hinted that it might view the Fed differently. And this protective stance towards the Fed was put forward by two conservative judges of the Supreme Court. Writing in a case involving funding for the CFPB, Justice Samuel Alito described the Fed as a unique institution with a unique historical background. Fellow conservative Neil Gorsuch joined the opinion. Plus, there is one more factor that speaks strongly in favor of the Fed's independence. According to a senior fellow at the Brookings Institution, Trump is too afraid of what it would do to global financial markets to try to seize control of the Fed. And indeed, the last time Trump and Powell had their spat over lowering interest rates and the Fed's independence in 2018, during the first Trump administration, markets promptly tumbled. But of course, presidents probably wouldn't be presidents if they didn't try to influence even an independent Fed whose board members can't be removed. Which brings us to the next question for today's video. How else could the president try to influence the decisions of the Fed? Now, the first and most obvious way for a president to influence the direction of the Fed is to wait for the opportunity to appoint new members to the board and to the chairmanship. That's how presidents have been trying to influence the Fed ever since it became independent in 1951. And by the way, that's also how presidents have been shaping the Supreme Court's philosophy since the beginning of the Republic. For example, the appointment of Paul Volcker as chairman of the Fed in 1979 was probably one of the key decisions that ultimately allowed the U.S. to get inflation back under control and leave the messy 1970s behind, as some of you who lived through this period may still remember. Now, new members of the Fed's board or new Fed chairman don't get appointed every month or even every year. In fact, Trump's next two opportunities will be in January 2026, when Adriana Kugler's term as a Fed board member expires, and then in May 2026, when Powell's term as chairman of the Fed ends. Although Powell may stay on as a simple member of the board until his full term expires in January 2028. So that will require a bit of patience on Trump's part. In the meantime, the only other way of trying to influence the Fed that Trump has is to exert some public pressure on it, which may have been the purpose of his public exchange with Powell that we discussed at the beginning of this video. Or maybe the president can try to talk to Powell privately, hoping to put in a word for his side of the argument. Other than that, and barring a change to the law, there's not much the president can currently do. On the financial side, the Fed is independent because it gets the revenue it needs to maintain its operations from the interest on the bonds it owns and doesn't need to be funded via the government's yearly budget process. So, based on the current situation, our opinion is that the Fed's independence might be around for a while and that Powell's job is as secure as it gets for the time being. Only time will tell, though. It wouldn't be an understatement to say that we've all seen our fair share of surprises over the past few months. And on that note, let's move on now to the next section of today's video and see where rates ended the week after the FOMC meeting and the back and forth between Powell and Trump. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's daily Treasury par yield curve rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. The 2-month and 3-month were unchanged. All the other maturities were down week over week, driven by fears of slower economic growth and higher inflation, as we shared in this recent community post per the FOMC meeting. Annual GDP growth expectations for this year were revised downwards to 1.7% from 2.1% previously, and inflation expectations were revised upwards to 2.7% from 2.5% previously. The 5-year was down the most at 9 basis points, followed by the 2-year, 3-year, and 7-year, which were down by 8 basis points each. So overall, not a good week for bond yields. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 6-month remains the only Treasury that is still slightly higher than where it started the year. And this week, clinging on by just 1 basis point versus 4 basis points last week. All the other maturities are down since the beginning of 2025, with the most significant downward moves to be seen on the 2 through 10-year maturities. The yield curve has stayed more or less the same, meaning that despite the FOMC's lower growth and higher inflation projections, both the comparison of the 2-year with the 10-year and the 1-month with the 30-year are not inverted, and the longer maturities still pay a bit more than the shorter maturities in these pairs. So, in this sense, the bond market may not be flashing red with signs of an immediate recession expectation, or otherwise. In any case, we'll keep monitoring the space as always. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's 2, 5, and 7-year Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down further, we can see the 2-year, 5-year, and 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. Also on the schedule is this 2-year floating rate note reopening auction. At the time of this taping, on Fidelity's platform, here's what the coupon and the expected yield are for the 2-year T-note. Here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For agency bonds, the highest yielding new issue on Fidelity right now is still from Federal Farm Credit Banks at 5.82%, with a first call date in June 2025. Here's the CUSIP for those of you who may be interested. For corporate bonds, the highest yielding new issue is from Jefferies Financial Group at 6.5%, which is fairly high given where Treasury yields currently stand. Perhaps Jefferies really needs the money. The first call date is in March 2026. Here's the CUSIP for those of you who may be interested. This other bond from Jefferies has a coupon of 6% only, but the first call date is in March 2028. Here's the CUSIP for those of you who may be interested. For brokered CDs, the highest yielding one is again from Jonesboro State Bank at 4.55%, with a first call date in June 2025. And for bank CDs, Marcus by Goldman Sachs is still running its 14-month high-yield CD at 4.5% APY. That's good through May 28th, 2025. From the comments we've seen on this channel, it appears quite a few of our Diamond Nest Egg regulars like this one. All right, members, super savers, and Bond Course fans, I hope you enjoyed this video and learned something new. And as always, if you want to learn more about treasuries and bond investing in general, then check out this video here on our bond courses. And come join our next live member Q&A this weekend, Sunday, March 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2-, 5-, and 7-year Treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. And for those of you who also subscribe to Your Financial Journey, check out Ava's latest video on Elon Musk and how his financial journey led him to become the richest person in the world, sans politics. If you prefer other billionaires, here's a fun one from Caitlin showcasing the top 100 richest people in the world. I've linked both of them in the first pinned comment below as well. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.